Stephen Bouchey, President and CEO of Bouchey Financial Group in Troy, joins us live here. And Chris Pallone tended to focus on how things are going to increase, how rates are going to increase on mortgages, auto loans, credit cards. What's the upside?
So the Fed's doing their job. They want to slow down the economy by making it more expensive for consumers, businesses, and so forth to borrow money, spend money. And that's the whole point of increasing interest rates. The good side is for those savers that have money in savings accounts, they're going to be paid a little bit more than they've been paid in over 15 years.
And that's good news. Is now a good time to get in the market, or should people still be watching cautiously?
In a nutshell, 2.5 years ago, COVID, the market was down 34%. 15 years ago, the market was down 50%. Today, we're down about 14%. We were down 23% just 2 weeks ago. Yes, this is a good time for long-term investors to buy.
Where should we be looking, Steve, for those who are novices and been thinking about perhaps investing at the right time? What sort of sectors should we be looking at?
Most investors should buy the broad stock market, whether it be the S&P 500 index or NASDAQ if they want a little bit of growth. Those two indexes would probably be two of the better indexes to buy.
What do you expect these rate hikes to do to the mortgage market in particular? It's been a seller's market here for 2-3 years now. Will it make homes more accessible to people, do you think, by raising these rates, even though the mortgage rate is going to go up?
Well, we've been in a hot housing market, obviously. Mortgage rates went from 2 to 3%. Now they're in the 5 to 6% range. They've actually come down over the last couple weeks. We'll see what happens. They'll probably get nudged up a little bit, but long term, they're still historically low mortgage rates. If you go back 40 years ago, mortgage rates were almost 20%.
I have to ask you, because you were greeted by someone as you walked into the newsroom and they said to you, rough day today. But you had just the opposite reaction about the rate hike.
No, we were actually pleased to see the markets up. We expected 0.75% increase. If it was anything other than that, the markets would have probably been volatile. But this was baked into the cake, exactly what the markets were expecting.
Do you anticipate a recession? Because the reporting is that, you know, we're not out of the woods necessarily.
I'm not in the camp where I think we're going to have a recession. If we do, I think it'll be short-lived and shallow. You have 6 million unemployed people, 11 million jobs, corporate earnings are good. Historic unemployment rate 3.6%, and the consumers out there spending money. With all of those things put into the equation, no, I don't think we're going to have a recession.
You told me what your definition is of recession, depression, and I like that. Care to share that with our viewers?
The saying is, when there's a recession, your neighbor's losing their job. If you lose your job, it's a depression. As I said, there's 2 jobs for every person that needs to look for a job. Yeah. I don't think we're going to be pushed into a big, deep recession.
Excellent. Steve Bouchey, thank you very much.